The markets opened the week with a significant drop. Is this a reason for caution and more downside to come, or are we going to continue up as if nothing has happened? Now, the Swedish index dropped by 3.5% on Monday after a shooting star closing on Friday. And given the aggressive sell-off and momentum break at heavy trading volumes, we might have another bit down to go. But before establishing that, there are some critical things we need to determine before knowing where we're at and what to expect. But before anything, not financial advice, etc, etc. And please like, share and subscribe if this content helps you to better understand the current state of the markets. First of all, the good news is that we're still within the ascending channel on the hourly. Monday's move simply moved us to the bottom of it. On a bearish note, however, the index bounce on Tuesday was quite pathetic. The price made a piteous attempt to go up, but was immediately rejected at the horizontal resistance at 1792. The hourly RSI is in a very weak territory, and unless we break above the resistance level, we should prepare for some declines to follow. Any break below Monday's bottom, which also constitutes a horizontal support and a breakout from the ascending channel, would be a bearish warning of more downside to follow. Perhaps a duly needed one though. To add fuel to the shooting star formation, and to those of you who don't know what that is, a shooting star is a formation that takes place at a top, a local top in this case, after a steady price increase, at which the price is rejected by the bears and mainly consists of a long upward spike. The formation is then confirmed by a sell-off candle. But if the price rises after the shooting star, however, the formation was either a false signal or the candle is simply marking a possible resistance area around the price range of that candle. So, to add fuel to the shooting star formation, there are some other signs of weakness that we need to consider. Since April, the RSI on the daily has for most of the time been stuck between the green RSI 50 and the upper bearish blue line. This testifies to a hesitant market as the price move, despite its strong move percentually, has not been fueled by confidence and power. For as we know, the strong price moves take place in the higher RSI regions, or what the uninformed will think of simply as the overbought level. What I particularly like about the RSI move yesterday is how far it actually moved. Constance M. Brown talks about this in her book, Technical Analysis for the Trading Professional, that if the RSI moves disproportionately much to the price, then price talks. This especially holds true when the RSI reaches extreme levels upon which a correction brings the RSI back into a normal range from a normal price correctional move. In this case, we can see that the RSI has already moved significantly. For to be honest with you, I would be much more worried and suspicious if the RSI were to move 5 points rather than the 18 we got from this price drop. That would indicate that the index by no means is ready on the downside. In this case, however, it rather tells us that a downside might be expected, but a limited such. And speaking of the RSI, we do have a long bearish RSI divergence on the daily since the 4th of June, although a subtle one. So, if we were to break out of the ascending channel and begin a temporary correction, what levels are we likely looking at? The primary support levels to look out for are the EMA 200 on the daily, the green Ichimoku support on the daily, the 236 fib level, which nicely coincides with a horizontal support as well as a recent local bottom. This horizontal support was also the index all-time high in 2015. A clear lower bullish red RSI closing on the daily or the weekly, and the 382 fib level on the weekly, as it will likely coincide with the weekly EMA 200 as well as the green Ichimoku Kumo. Of course, it could still go lower than that, for the market is a psychopathic sadist, but if that happens, we'll deal with it then, and we will probably see warning signs along the way. But if we were to get an index correction by breaking out of the ascending channel and taking out a new local low, I expect my small and mid-cap holdings to be affected exponentially in the short run. For I already see quickly weakening short-term technicals in a lot of stocks, and in such case I will sell off a good proportion of my current swing holdings to release cash.
Well, it's rather brutal here. We're advising our clients to put everything they've got into canned food and shotgun.
That cash will then be used to buy back the same stocks at cheaper prices, as I still expect parabolic index moves to follow before this drunken party is over and everyone skips the hangover part and goes straight to dying from alcohol poisoning. For more on that, please watch the Market is a Beast episode. Now, don't get me wrong, the market is still strong and shows immense potentials. However, if I can stand by the sidelines during a negative correctional move, it will eventually equip me with a stronger portfolio and with more of the same stocks. That's how the world of swing trading works. That was all for now. Thank you and goodbye.